Yeah, so we've received apologies from Councillor Peter Wharf and Councillor Howard Legg.
Yes, I believe Howard is away. Yeah.
And then we have Adrian Felgate, Councillor Bobby Dove, and David Wilkes joining remotely.
Thank you very much. And hard like David, we know, is suffering from coronavirus, so hopefully you'll be able to stay with us for the whole morning, and hopefully you get better very, very soon. Yes. You're right, you can't hear me. Sorry, you're quite right. Yes, I've had the same training, but it is difficult to not do it. I was just saying earlier on that it could do with the screen up there, so I can actually see people, but it hasn't quite got that. Moving on, though, to minutes from last time. Is everybody happy that they're a true and correct record of the meeting? Yes, thank you very much. Declarations of interest. Are there any declarations of interest today? No. Public participation. We amazingly don't have any questions or statements made by members of the public, which is quite unusual these days, but I think they probably recognise that the big decision-making meetings are coming up in the future, and less so today. Questions from members. Again, I have no questions from members. Also, there are no urgent items either. So we're moving on pretty much straight away to item 7, quarterly report from our Brunel Partnership. David Cox and Luke O'Donnell here with us today. And if you want to fire away, you're more than welcome to.
Great, thank you. So yeah, my name is David Cox. I'm the Deputy Chief Investment Officer at Brunel Pension Partnership. So today I've been asked to come along and speak to you about the markets and performance over the last quarter, but I thought I'd just give you a backdrop to what we've been seeing. So I'm sure a lot of you have been seeing in the news many stories that have been talked about, and I thought I'd just give a recap and summary as a background and then maybe move on to some examples. I have provided a presentation, so hopefully members can see a copy of that that's been circulated. But please, so I will refer to that in a second. So I just want to take you back really to markets have been very difficult over the last few months, and they continue into this quarter as well. If I just take you back to December, I think it's strange to think that in December we were talking about Omicron and whether we would actually have Christmas with our families again, and that actually wasn't that long ago. And I think we're very fortunate today in the UK to be sitting in this council room, being able to talk to each other face to face. But actually that's not the case around the world, and China being a really good example, the second largest economy in the world, which has been in heavy lockdown and only just coming out of that now. So, I think it's strange to think back it's only December, but that is where we are today. In January, we saw central banks become very hawkish and looking at raising rates. So we did see central banks raise rates. We've also seen central banks tighten quantitative easing, which is something that's probably been talked about for the last nearly 15 years, not quite 15 years, but 10 years at the very least, and actually reverse some of the programs of work they've got. Even over the last week, the European Union has come out and said it will be very much tightening, if not reversing, its programs. And that's really important in the context because the central banks have provided a lot of cash into the markets and into economies. And they actually, at times, were the largest holder of corporate bonds in the US, and they were also some of the largest buyers and sources of liquidity in markets across Europe as well. And that's quite a material change from where we were probably 20 years ago. And obviously the devastating news that came after that of the Russia invasion of Ukraine, obviously since then we've seen commodity prices really go up, the talk of inflation and the driver of inflation being commodity prices. So obviously oil and gas we're all feeling, so anyone that's had to fill up their car with petrol recently or even charge their car recently has probably felt the cost of commodities going up. Worth noting that Russia and Ukraine are either the second or third or fourth largest exporter of cereals, whether that's wheat or corn or other grains. And obviously Ukraine being a huge exporter of the likes of vegetable oils, and that has huge impacts to food production and elsewhere around the world. So just a reminder, India has decided not to export certain goods now, which has material impact to the global supply. So obviously we're seeing inflation rise. I think the inflation we're seeing at the moment, I think banks are saying over 10%. I think that doesn't mean it hit 10% and fall back. I think it is over 10%. I think in the UK particularly, we've still got supply chain issues. We've still got fuel issues where our demand has certainly dropped off over the summer, but as demand comes back in the winter, that will certainly be an issue. And I think the fact that in Ukraine, particularly, they're not planting seed for next harvest at the moment will really feed into that. So, I think inflation will continue to rise. So even though the spike of inflation a year ago is priced today, and that will not be included, I think we still have other inflationary shocks to come. So moving maybe into country specifics, I mentioned China just a minute ago. So we've obviously seen China lockdowns. That's really hit the growth in China. So just a reminder, China really looks for double-digit growth. It sees a 6% growth rate as very, very slow. And actually they're slowing around that figure, if not below. And I think given the lockdowns, it'd be very interesting to see where they come out of that. Alongside that, the governments there have really clamped down on certain activities. So we've seen technology, finance and education really hit hard by regulation. So private education was essentially regulated to the point of it couldn't exist. So any listed company in China that was an education provider essentially was put out of business by the Chinese government. Also, as I said, finance and technology, where they saw these big companies getting too big for themselves, they've really clamped down on those. And obviously, we've also seen a property collapse. A number of companies have really struggled. The debt has all but been written off, and it's been a very struggling time. Now, China, we don't necessarily have a very large exposure to, but it's worth noting it is the second largest economy in the world, and therefore it is extremely important. It is still on track to become the largest economy in the world by 2030. In the US, which is obviously the largest economy, we have seen markets materially fall. So as of yesterday, the US markets moved into bear territory. Bear territory is defined as a 20% fall in markets from its last peak. That's, again, quite a significant indicator of where we're going to on a forward look, which I'll touch on in a minute. But, markets have been hit really hard this year, and that has continued into this quarter. So I will talk about Q1 performance, but it's continued into Q2. And in the UK, obviously, we have, in the UK market, what's defined as the UK market by FTSE is very oil, mining, and healthcare and banks heavy. So a lot of the top stocks in that index are led by that. So where we've seen oil prices, we have seen larger profits, maybe less so reflected in the share price of oil companies, but definitely in banking, where we've seen raising rates helping banks. And it's worth noting, volatility remains a big issue in markets, and volatility is usually driven by uncertainty. So if everything's certain, then obviously volatility will be non-existent, but we were seeing very high volatility. So volatility is significantly higher than it was pre-pandemic. So obviously we would have thought volatility heightens in pandemic. We certainly would have thought it would happen during essentially an invasion of a European country. But that's continued to be elevated on the long-term basis as well. And for the first time in quite some time, we've seen material falls in equities and material falls in bonds, including government bonds, as interest rates are expected to rise. So that's all very happy news, and probably, sorry for starting off the meeting in such a depressing way, but I think it's important to set the context of the markets of where we are, and then maybe where we're going. So I think it's fairly clear to me that we're probably heading towards some kind of recession in most, if not all, countries globally. We're seeing an end to globalization as we knew it. This open and free trading in markets and free movement of goods, whether taxed or not, and a much more kind of inward-looking policies, particularly obviously around energy, which has been very, very clear to see. But I think if we hit a recession coming out the back end of this, which the market movements we've seen and various other shifts we've seen certainly indicate a recession. It will be around what kind of recession we see. So will we see a long depression, which we haven't seen in some time? Well, that's hopefully not the case. Will we just see a balance sheet recession where companies' balance sheets are really pushed to the limit, in which case certain companies will do very well and certain companies won't do very well? Certainly things like Woolworths, as an example of something we don't see on our high streets today, will really suffer in a balance sheet recession because it was heavily debt-laden and not a very good quality company as we would see it. And the way that we position our portfolios is very much looking at quality companies, as we call them. I don't mean quality companies by companies we think are good quality. We mean companies that have very strong balance sheets, have good return on their equity, have good debt to equity ratios, etc. So on the forward look, as I mentioned, the potential for going into recession. I think we are seeing performance persist into Q2 on a lesser extent, it has to be said, from the shocks that we experienced in Q1. But I think we will experience a longer-term trend of rising rates, rising inflation in the short term, particularly, with that potentially falling back to near norms, but still above the Bank of England rate of expectation, which is 2%, which is the target they have. And essentially our view is still that the higher quality companies that we invest into will continue to perform. And higher quality companies doesn't necessarily mean that we'll be taking bets and taking directional views on what we think, because the timing of these things is extremely difficult. Cheap companies have been cheap for a very long time, expensive companies have been expensive for a very long time. But actually expensive companies have only got more expensive and cheap companies have only got cheaper until a reversal in February this year. So I wanted to go through a couple of slides that I've actually got here, if that's okay, and just to put into graphical form.
Should we just check that everyone has got a copy of the...
So the first slide I want to talk to...
This one, which you should all...
Yeah.
Okay.
So the first slide I wanted to talk to was the short-term headwinds for responsible investment. So just a reminder, Brunel and its partner funds are set out to have a very strong responsible investment ethos. Could you please say the page number on your page? I don't have a page number, unfortunately. It's the third page.
It's titled...
Certainly, so I thought it was going on the screen. So.
I think... Yeah, he's looking at the quarterly report.
This isn't the quarterly pack we sent through.
Chairman, do you want me to share it on the screen? I can share it from here on the screen if that helps people.
Yes, please. Thank you.
Can you see that?
Perfect. Thank you very much. So what we've tried to do here in the next couple of slides is just indicate how markets have essentially dislocated, is how I probably try to describe it. So markets have been very directional. And as I said, we don't take directional bets. We look to have balanced portfolios that will perform in the long term. So this chart here essentially is showing on the left-hand side, something that has a strong tilt, and something on the right-hand side that has a negative tilt. So what I mean by that is, so the blue is the carbon intensity of companies, and the orange is what we call the ESG score, so the responsible investment score, if to simplify it down to its granularity. So it's environmental, it's social, and it's governance scoring of a company. And what we've seen is the performance of companies that have strong responsible investment and companies that have lower carbon intensity have actually materially underperformed. In actual fact, all of them have underperformed apart from those with extremely strong carbon intensity and very negative ESG scoring. And that's quite important because we would never sit in that right-hand bucket in the same way we probably would have very little in the left-hand bucket. We would generally sit around the middle trying to be balanced. But here we've seen a very sharp reversal where essentially markets have said, look, unless you invest into what we would class as the most carbon intensive and poorest run things, you would have underperformed. And it's as black and white as that, really. So David, if you wouldn't mind switching to the next slide. Happy to take any questions at any point as well, by the way, please. So I appreciate this is very small on screen, but if you've got it in front of you, this is essentially showing a 14-year trend, so since 2009, of how markets have performed. And what we've tried to do here is split it out. So we've got, at the top of the slide, we've got things like low volatility stocks or growth stocks. And then further near the bottom, we've got commodities at the very bottom. And we've got what we call value stocks is the next line up on that's the green bar there. And what we've seen is a relative underperformance of things like commodities and value stocks, actually an outperformance of quality stocks and growth stocks. But actually in the last quarter, so that very right-hand side, particularly if you look at the bottom one, you see a very sharp reversal. So all the things that have been doing very well and all the things that have been doing not very well have done the complete opposite in the quarter. And again, we would never look to time these things because, again, if I'd said to you in 2009, I think holding commodities is a good idea, I would have been wrong for 14 years, or 14 years less the quarter, and I would have been right for one proportion. So again, it's just showing that the markets have materially shifted. But again, we're hoping those will settle down as we move forward, and particularly over the long run. Next slide, please, David. So yes, the next. Thank you very much. So this one is talking, the top part here is talking about kind of macro events such as rates, inflation, and the US dollar. So from left to blue is how correlated a company is to rates, how correlated a company is to inflation, and then how correlated a company is to the US dollar. US dollar is at record levels, is very expensive, yet the US economy, one might argue, isn't reflecting its valuation, but again, driven by the things we mentioned earlier of commodities, etc. And again, unless we took a very strong material bet in Q1 of these strong positive correlated activities performing, we would have underperformed. So everything from the first slide on, from the first chart onwards shows an underperformance. And again, the next one down shows that the performance of value, which again, this is, for those of interest in the technicalities, this is dividend yield, price to earnings, and price to free cash flow. But essentially, they are indicators of whether a company is value or not, or cheap. And again, unless you invested in the cheapest stocks, i.e. you had the most value stocks, again, you would have seen an underperformance. So again, we would never take a material bet on those things. If you wouldn't mind moving to the next one, please, David. The next two are growth and quality. So again, it's a very similar story, and we would generally sit in the middle / to the left of these two charts. But again, on the right-hand side, you would basically have had to take a directional bet on growth, i.e. an anti-growth view, and then the same on quality. You would have had to take a view on mild negative tilted companies, i.e. companies that weren't particularly good quality, I didn't have very good balance sheets. So that is essentially the way that we've seen markets. And I think that's reflected in the performance at Brunel. So I will just say one more thing before I kind of am more quiet. But essentially, we have seen performance really shift in the quarter. So the global high alpha portfolio you hold was ahead of benchmark at the end of Q4 and is now materially behind benchmark as of the end of Q1. We've seen performance against the benchmark fall again, but actually less materially than you see there, than you saw in Q1. And that is the same for sustainable again. So sustainable was slightly ahead of benchmark and is now behind benchmark as of Q1 for the numbers that you've got in your quarterly report. So I'm proposing to stop there and take any questions that anyone might have, really.
Steve? start. So, yeah, I'm just trying to sort of think about the things you've been saying, David, which are quite detailed in the explanation of the factors and so on. But at the end of the day, I've been around a long time listening to fund managers talk about quality stocks. I remember, back in the 80s, back in the 90s, same old story. I wonder how many of those quality stocks around in the 80s are still around today. I think quite a lot of them are not, actually. So I'm coming from a slightly cynical and skeptical position on kind of some of these definitions, the way that stocks are categorized. But it's undoubtedly the case that there's been a big shift in the past 6 to 12 months in terms of the factors in the market. For 10 years, because of quantitative easing, markets ignored things like value stocks, and they just focused on out-and-out growth stocks, and those became very inflated. So it strikes me, looking at the performance, that the problem with the performance is that essentially one can quite understand why you're not exposed to energy stocks. We don't want you to be exposed to energy stocks. That's kind of forgivable in a way. But it looks to me, looking at your portfolios, which underperform between 2 and 7% over the kind of past 12 months. It looks to me like with the weighting you've got in technology stocks, which are 20 or 25% of the portfolio, that you've essentially invested in a bunch of overvalued technology stocks that did very well in a long period of low interest rates. And that environment has fundamentally shifted in a way that's immediately adversely affected the performance of the portfolios. And I think it will be quite... I'm interested going forward whether you think you can kind of gain that performance back in a way. I think there'll be some recovery, but I think if you're investing on the basis that the next 10 years is going to be like the last 10 years, I think that's definitely wrong. Do you want to respond to that?
I mean, yes, that's quite a full statement, I suppose. So yeah, I think the analysis we've done of performance isn't that technology has driven our performance at all. In fact, it's the things we don't hold that have driven our performance more than the things we do hold. So to your point around being underweight, high carbon intensive companies, that is what's driven our performance. So it's not the relative sell down of a technology stock. It's the relative outperformance of an oil and gas stock in a down market that may have driven our performance, for example. So actually, we do have energy exposure in Global High Alpha as an example, and one of our best performing stocks is a Canadian mining company. So we do have those exposures, and actually that's what's helped the portfolio in certain areas. I think it's very easy to focus on the one or two mandates that have a lot of technology stocks. So we have a 15% exposure to Baillie Gifford. So just a reminder, that's 15%. It's not 85%. That has a technology biased approach. We have a 30% exposure to a quality manager that has very few technology stocks in it and is an out-and-out quality manager. It actually is very well balanced in its growth and value outlook. But again, they have been hit not by the performance or underperformance of technology, but actually the outperformance of those stocks that I went through, also the themes that I went through earlier. So just one addition I would say is I think for the sustainable mandate that you have with us, the expectation is this does have a quality growth bias to it. And I think that has to be recognised that is within the product design that the clients asked us to set out as well. So I think that is really important. And the same for the Global High Alpha portfolio. It should have a positive tilt towards quality names again within the product specification that the clients asked us to set out. So thank you.
Mr. Brown?
Yeah, it's really interesting actually to see how things have shifted in the last sort of quarter or so, and the sort of thinking behind it, and the reason that's sort of gone against sort of our portfolio and Brunel. But I guess the $1 million question is, is that one quarter's blip, or is that going to continue quarter on quarter, or how do you see this? Has there been a fundamental shift that we need to then address in our sort of investment management approach, or is it a case of we need to think about tweaking things? Or I suppose the question for us is how does this go in the future? Does it continue quarter on quarter, and we start our performance really does underperform, or do we feel things are going to turn around or get back to where it was before, or are we never going to get back to where we were before? That's the $1 million question, isn't it?
Yeah, so I think the outlook for the portfolios, as I mentioned earlier, the volatility is still very high. We've gone into this period with essentially uncertainty, and typically the active managers we have wouldn't perform well going into uncertainty, but our expectation is, and if this isn't the case, then come back to me, which is they should perform coming out of uncertainty. They should be positioning their portfolios well to take advantage of the uncertainty that's being created and then position their portfolios. So, for example, we are looking at managers and what exposures they have and how they would take advantage of the cyclical markets we're going through at the moment. So, how well positioned are they? Have they rechecked? The business cases or the user cases that are happening given the scenarios we've got? So, for example, if I was invested in a Russian company that relies 100% on exportation to Europe, I might suggest that name doesn't have the same business case it did at the end of last year. We don't have those names, fortunately, but it's just an example to say we need to managers need to reviewing the names they've got to make sure they're taking advantage going forward. I think it's worth noting that we talk about technology stocks and overvalue because it's kind of quite handy, and we've seen essentially the multiples, which is how expensive they are or how we think about them, reduced significantly, and names we thought might be expensive are now actually relatively cheap. So where our managers hold those stocks today, in theory, they have the ability to ride those through in the long term. How long this will persist for and how long this uncertainty will persist for, I think is a really interesting one. I think there are a number of issues, particularly energy, that will need to sort themselves out. When you've got markets like Europe exiting the only supply of gas and oil that they heavily rely on it with no alternatives, that is a huge issue. When there's huge issues with supply and demand because of China or because of food production in Ukraine, that's a huge issue. So I think once we turn those corners, then I think we will see performance. I think the other thing to note is markets usually price in now and what's understood now. So, for example, 10% inflation is what people talk about. That's priced in now and forever on a very short-term model, because generally markets which have investment banks taking part of them are thinking about today's P&L and today's valuation. What we like from our managers is they're aligned to the way that you should run pension funds, which is for the long-term benefit. And therefore, they're not looking at the now, they're looking at now, next 3 months, 6 months, year, 2 years. And some of our managers look out 10 years as to what they think the opportunity set is, either for that company, the industry, the sector, the technology, or whatever it might be. So I think the fact we've got managers looking beyond the current blip is really important to me, to make sure that I can come back to you in a period, let's say next year, and I can talk to you about how the performance is recovered.
I will come to you, Steve, but I just want to follow on from that, actually, to ask you specifically about what you feel about oil prices over the next 3, 6, 9 months, going off into the distant future, and real yields as well. What is your feelings about real yields and how they're developing?
Certainly. So if I take energy prices in particular, I mean, my view is that we will see upward shifts as demand rises in Europe coming into winter. I think even if the Ukraine crisis were to finish today, I don't see an unwinding of what's happened quickly. So where people may have been able to stock up on their reserves of gas and oil during the summer, I think once that demand hits, we're talking to managers and we're talking to economists now who are actually thinking about oil prices at 160, 180, 200 a barrel, which obviously will be devastating in a number of ways. Whether that actually happens or not is very difficult. Whether governments have to step in and start subsidising in different ways and how they're going to do that, whether that's in Europe or in US or UK, will be very interesting. I think, again, energy markets are, even though we talk about global oil prices, actually supply and demand is very regionalised typically. So the US typically relies on itself in Canada and a small amount of import elsewhere. Obviously, Europe was relying heavily on Russia as a neighbour. So I think, I think we will probably see oil prices stay at an elevated level, if not higher, going into winter.
Does that necessarily lead on to a recession that's going to be deeper than people expect? Because if you're talking about the energy prices being at the sort of levels you're talking about, that's going to have a major impact on consumer demand, isn't it? I mean, we already see very rocky consumer confidence numbers coming around, but if you start telling people that energy prices are going up another 50% or something, that's going to really hit people in the pocket and their confidence about buying things.
Yeah, I mean, I think that's part of the uncertainty is what kind of recession we're going to have. And I think we're certainly talking to our managers and companies around those kind of consumer discretionary items, how much elasticity in the pricing do they actually have to keep up with inflation. So if you took a Netflix, for example, as soon as Netflix put their price up early this year, 10% of their subscribers went, well, I don't need to renew that then, thank you very much. In fact, it reminded them they didn't need Netflix, as an example. So where companies may have thought they could put their prices up by 2% a year or 50p or whatever, that may not exist. So we are working on particularly those discretionary items and how much those discretionary items do we think are as robust as maybe other people thought going into it. I think on your point on real yields, I think, yeah, we'll definitely see real yields rise for the rest of the year. I think the US is already priced in for this year 75 basis point of rate rises with 250 basis points of rate rises by the end of next year. That is completely unheard of in a non-recessionary environment. So I think it'll be very interesting to see where we end up. But that is part of that uncertainty. So.
Steve next, and then Councillor Roberts. Okay.
Q2 is going to be a negative quarter as well. Can you just give us some feel for that, some numbers, so that we've got we know what to expect?
Yes, certainly. So it's worth. This isn't across all of our portfolios we run. This is just obviously specific to the portfolios that Dorset have. So within our global equity mandates, we're about 2.5% behind up to the end of May. So that's markets having fallen about 4%, 3.5%, 4%. And then in our behind a further 2.5% behind benchmark in Q. Sorry. So we're down to about just over 6.5. Yeah, you're quite right. And again, a similar but lesser story. So in UK equities, which were down about 1% versus benchmark quarter to date. As I said, just to remind, this isn't the picture we have across all of our portfolios. So we have a global low volatility portfolio as an example, which is actually ahead of benchmark, nearly 5% on a year-to-date basis. So it's actually up 10% on a one-year basis. And our Diversifying Returns Fund that we launched for clients, again, that's actually in positive territory on a 1 year. So whereas markets are down, as I mentioned, on a quarter to date 6%, that fund's up in positive territory by about 2%. So again, there are different portfolios doing different things, and they're actually acting as we might expect. Although obviously we're not happy about negative performance in any guise.
Thank you, Chairman. A couple of things on the fuel. It was not that long ago, fuel rose to $1.19 a litre, and the oil price was $1.33 a barrel. Can you explain why it's now nearly £2 in this country and it's not anywhere else? That's part of my question. But I read through the report with interest last night, your quarterly report. I was particularly interested from the Chief Executive. And I wondered what our pensioners would feel, that they might have assumed it was written by the head of HR, because there was absolutely nothing positive for our pensioners. How can we go back to our 40,000 people and say, this is what our main investment company is concerned, its ethos rather than its output? Thank you.
The same feeling when I read the report. I mean, to be honest, the Brunel report, when you get the the CEO writing sort of flibbly stuff. I mean, it needed to address. We've got a problem with our Brunel performance, and she needs to address that. She needs to describe, say something about why that is, rather than exactly as Councillor Roberts said, a kind of general kind of chat about stewardship. So I do think I've always given Brunel feedback on the client reports. It needs to address the needs of the clients, of the customers. It needs to say what is going on and explain things very clearly, and I don't think it does. So I endorse that kind of cautious negative feedback, really.
Thank you. I'll take that message back to my boss's boss, and I'm happy to do that. Not a problem at all. I think that's really good feedback actually to have directly. So thank you. Well, did you want me to answer the fuel question? Sorry, your point on fuel prices. Yeah.
There was something very wrong.
Cost of production is the main problem.
Well, we invested in the wrong times.
Yeah.
Because there's obviously millions being made.
Yeah. So it's the cost of production is the great issue. So actually, margins on production of fuels and plastics, which are byproducts of oil, are materially down. So yeah, it's the people drilling it out the ground and passing it on have made great profits as we've been seeing. But
yes, but is the cost of production any higher in France or Italy than it is in the UK? Because it's an awful lot cheaper, and I just wonder about our investment policy and how swift we can be in taking advantage of short. I know it's very difficult to move in and out quickly.
That's not really our style. I mean, our objective is obviously to look over the long term, not to try and cherry pick things in the short term, which is a whole different ball game. Anyway, Councillor Christopher next.
Yes, I want to take us back to an earlier comment about Bailey Gifford and poor performance and the Scottish Mortgage Investment Trust contained within, and the fact that obviously that was previously a well-performing stock. Clearly, many of us are alive to the fact that what happened in the past isn't always a guide to the future. When we started studying things in the 1980s, the most successful stock in the 80s was Polly Peck, and we all know what happened with that. Clearly, one of the most important questions here is how long the conflict in Ukraine will persist. At the start of the presentation, it was a very well laid out set of figures indicating the impact across the board of the conflict and the amount of world supply of maize and grain and minerals, etc., that actually derive from those two disturbed countries. It's particularly interesting the comments recently about the whole question of stagflation, i.e. whether we actually have stagnation and inflation. But what we may actually be looking at is a movement in the Phillips curve to the right, where we actually have increased unemployment, and we also have increased inflation, and the Phillips curve may well move to the right, and that is exceedingly alarming. Other points to make are around the whole question of whether we are sufficiently diversified. Mention has been made of the fact that one hasn't benefited from looking at good figures, and indeed whether lots of money has been made in energy stocks, etc. Much has been made about the price of UK fuel prices and the associated American driving season and all the words that have been written about petrol supplies and petrol being exported across the Atlantic at this time of year. But the question is, are we fully diversified across the world where perhaps opportunities could have been taken advantage of, perhaps in, say, Latin America, which is a totally different world to our totally disturbed European position And I would welcome your comment on that. Thank you.
Yeah, so I think on the diversification point, so depending on which portfolio you're looking at, so if we just take the global high alpha, we do have a number of managers with different styles which we've blended. So whether that's Bailey Gifford, which is our out-and-out growth portfolio, or Fiera, which is our quality manager, or Harris, which is our value manager, and we get two others there as well. But so we have blended them to get the style outcome that we had been asked to do. So again, just as a reminder, we were looking for a quality bias in that portfolio. We do regularly review, and we've actually just rebalanced the global high alpha portfolio to give more money to Royal London, which is more of a cyclical investment. So it looks at business cycles and where in the business cycle you might want to invest in a company, and looks to balance across different companies in different business cycles. So I think that the balance there is always under review. But again, we don't look to market time. It's all but impossible to know what's going to happen until it's already happened. So with these companies that have done very well per the charts I provided, that happens very quickly and very sharply in a very short period of time. And there's no way of you being able to time that. You can time that in a hindsight perspective, going, should we, could we? And the answer is always, yes, you could have done in hindsight, but actually what information did you have at that point to make that specific decision at that specific time? So on the point on South America, we do have a good exposure to South America in our emerging markets fund. But Global High Alpha, which doesn't, its benchmark is X emerging markets, we don't have a weight to South America to take advantage of those particular names, but we do in our emerging markets. And actually there's other issues in some of South American countries, such as Brazil, where actually currency management has been one of the biggest challenges, because you can't hedge those currencies. The cost of doing so is very expensive, yet the way that Bolsonaro in Brazil's managed the country during COVID, as an example, has materially hurt the way they manage their currency.
Yeah, as a firm, could you you mentioned there you'd allocated more money to Royal London. Can you explain, because in your jobs choosing underlying fund managers, how you avoid the trap of increasing allocation or buying managers who have performed in the past but may, for some reason falter in the future, and selling managers who have underperformed and may outperform in the future, depending on the factors underlying. But, how do you involve chasing your tails is what I'm asking.
Yes, I think the Royal London one is interesting, because we actually invested into that strategy very early in its inception. So there was a very short track record, and typically we wouldn't want to put a lot of money with an early stage, but we really like the strategy. We think it's really well thought out, and I think the way that they look at the market conditions as we currently see them, but also as we see them into the future, is very good. What we've tried to do is take risk off the table in other areas, such as growth as an example, but non-cyclical names as well. So we've actually increased Royal London, we've slightly increased our value exposure with Harris, and we've slightly pulled back on Bailey Gifford, but only by 1% or 2%, and also on our out-and-out quality manager as well. But it's not about timing historic performance, it's about reviewing how balanced the portfolio is versus the mandate that we've been set by clients. But yeah, we would never look to see, in fact, we're very sceptical. So one of our other portfolios, the manager has closed its strategy. We're very sceptical of past performance equals future performance, because that is typically not the way. Actually, it's sometimes quite the opposite, which is, should we be selling this manager because they are at the top of their performance cycle?
I've got one final question, actually. And you obviously concentrate on the funds we invested in, and I don't quite understand why you've done that. But I just wonder if you could give an indication of how the funds that were launched around autumn last year, the passive funds based on the Paris Climate Accords, and how they've done compared to the broad passive funds.
Yeah, certainly. So a very similar story, really. So from launch up until the end of December, the passive, so the climate aligned and Paris aligned products outperformed their parent non-aligned index. And then That continued into January as it did for the active range, but then in late January and through February they got hits. They did underperform. But again, that's again a structural underweight to high carbon intensive companies, which is, if you remove those, you've underperformed as I showed you. So the Paris aligned, which excludes a lot of fossil fuels, performed slightly worse, and we're talking 2% underperformance versus the climate transition benchmark, which doesn't exclude them, but it tilts materially away from them to reduce the carbon exposure. That still underperformed, but less so. But again, that's the kind of yes. So again, that trend continues. So again, it's a marginal underperformance. We're talking a handful of basis points, no more than 100 basis points.
Just to clarify, you talk about against the benchmark or against the more the funds that we have passive funds?
So that's against its parent benchmark. It has outperformed the active range.
It's basically so the two. I thought I heard you say that the two underperformed by 2%. So the PAB and the CTB, those two funds, how much have they underperformed the world index, the market cap benchmark, since their launch in September, was it, or in the winter? Yeah.
Sorry. Yes, that was 2% on the quarter, but it has outperformed the active range. So if you look at the Sustainable Equity Fund or the Global High Alpha Fund, CTB and PAB have outperformed that.
Yeah, thanks, Chair. Yeah, just as the discussion's been on, coming back to the sort of question I had earlier, and which is really a sort of question for all of us, isn't it, to think how long term is this shift, or is it going to turn back to how things were before? Just with your knowledge of sort of the actual underlying investments that we've got in the various portfolios, it strikes me that some of this impact in the last quarter, sort of 6 months, some of it is going to be long term. There's a sort of fundamental shift in how things are going and sort of globalization. Some of it will be short term. You know, we all seen sort of big companies in the headlines of McDonald's, Marks and Spencer's, that pulling out of Russia, taking a financial hit. So it'll be a one-off financial hit for those companies, but then, you know, they'll hopefully carry on, minus their sort of Russian activities. So from the investments we've got, what's your feeling about how many of those companies have taken a hit, which will be a one-off short-term hit, as opposed to, you know, it's a sort of long-term shift? Oh, sorry.
Thank you. Well, I think it's certainly a mixed picture, and I think that's where we challenge managers quite heavily on a regular basis. So I think the majority of names, again, because the managers we invest with are long-term in nature, we look for them to have very strong outlooks on those companies over the long term. And that does mean that the majority of names that we see, we would expect to perform. So to your point, they've taken a hit. I think particularly in February, we saw companies come out with announcements that they had maybe missed their estimate. So the market thought they would create X amount of profit and X amount of revenue. They missed it by a bit and were hit extremely hard. That continues, so therefore they've priced in that kind of change now. That started to change actually in April and May, where actually companies was reporting missing targets, but actually their share price going up, which is typically what, you know, unless you materially missed it and it's a big surprise. We're now seeing maybe a more balanced view in the market, but essentially everyone was being punished. So I think the number of names that we've got where they've been punished, they've now got priced in the short-term effects. As I mentioned as well, that the markets generally price in the short term, and they're very reluctant to price in the long term. There's nuances around that, but that's certainly the kind of the generalisation in markets. So as I said, I think we've come into huge amounts of uncertainty. Where we end up with monetary policy, where we end up with kind of financing and interest rates and recessions, I think will be really interesting. But we need to make sure our managers are best placed to have active returns coming out of that. So I think that's the main thing for us. I think that's where active managers do exceptionally well. I think we did a piece of work as well, just as a side of, we've got managers that are underperforming, we've got managers that are outperforming their benchmark. How does that compare to the industry? And I think at a previous Dorset committee meeting, I did have a discussion around active versus passive. But actually, active managers in Q1, I think the stat was something like 70 to 80% of active managers underperformed in Q1. But that's not the persistence in performance that we're looking for. So we want to make sure that active managers over the long term, we're picking the best managers to have the best place to perform over the long run.
Are you able to tell us, talking about the percentage of managers that outperform, since their appointment by Brunel, since inception, what percentage of the managers you have appointed have outperformed their benchmarks?
Off the top of my head, no, sorry.
But could you come back to us with that figure? Thank you. Okay.
I'm not involved in investment, so I can't comment on this, but I'm here to represent, as part of Dorset Council. We're 89% funded in our pension scheme. At what point are we as a council going to have to increase the employer's contribution because you have failed to keep our balance? And what funding do you have to top up, which I guess is zero? So how long do we sort of sit with you before we have to go back to our ratepayers and say we're going to have to increase our council tax to top up the employer's contribution to maintain our pension? I know it's a big picture, but those are the sort of concerns that I feel we as members should be voicing.
Thank you, Councillor Roberts. I would have to say I'm not sure that question has to be directed at Brunel, but it's probably more the sort of question either for Steve or for Aidan to ponder.
I think we're coming up to evaluation, triennial evaluation, so that's where the contributions will be determined. I mean, if Aidan and Dave want to contribute at this point. So contribute to the discussion, not contribute to the... So that process is going to be going through to see what the contribution rate will be. So I don't think anybody can answer that question right at the minute, to be quite honest. But where you're coming from in direction with that question is a very valid concern to articulate and will be a major concern over the next year, I would say.
May I? Yes. When we were managing a bigger proportion of our funds, if we had an underperforming manager, we took the decision as a committee to move funds. I'm not sure that we still have that. Or could we withdraw? It's these big ones that I would like an answer. I want to know whether it's possible we could take half of our funding back from Brunel because we felt we could do a better job.
Yeah, I think that's... Pooling, shall I respond to that? Yeah. My perspective... Are we on? Yeah. My perspective is that pooling is here to stay. However, I also have a point of view, which is that I think the committee and all clients should always have plan Bs in mind. Now, I can't say what that plan B is at the moment, but I would think that the committee should be thinking about it over the next year or two, just in case things don't work out in the longer term. So I'm very keen to have a discussion at some point on plan B.
Aidan, did you want to comment on that as well?
Thank you. Good morning. Aidan Dunn, the Section 151 officer for Dorset Council. I think it gets to the heart of the challenge and the conversation, doesn't it? As we go through the valuation, that will look at the investment strategy as well as the sort of the profile of our pensioners as well. So yes, there will be a gap. Yes, there is the risk that we have to increase that pension contribution from the employers, and not just Dorset Council, is it? We represent so many employers here. So performance is crucial, and hopefully our colleagues from Brunel here have really got that sense from the conversation today about how important performance is to us, ranging from chief execs comments in the overview of how the fund's performing through to our expectations and requirements. And I think what we're seeing, just sort of a note really, is a sense of, as the partnership, Brunel partnership is maturing, our interest is moving far beyond the governance, which was where a lot of the conversation has been up to point, into understanding that performance and driving that performance. So I sort of reiterate Steve's comments here that, yeah, we need to be thinking about a plan B, but we're expecting a decent performance here, and that's what the benchmarks are for. So I just sort of reiterate those points, if I may. Thank you.
David, I believe you wanted to say something as well.
I had taken my hand down, but I think I could probably echoing comments that have been made. Obviously, the broader picture is we're in the middle of that. The actuaries are looking at that full valuation, and we hope that we will be seeing some indicative results, if not the final results, when we meet again in September. And then the next stage will then be to look at our overall investment strategy. So have we got the right? So there's two things. Have we got the right mix of investments, and our investment managers, i.e. Brunel, are they actually delivering on those things? So there's more to it than just the performance of Brunel. It's about looking at that mix of investments as well that we go into. But I think there's no question it continues to be a challenge to increase our funding ratio and alleviate that pressure on scheme employers, including Dorset Council, BCP Council, but the 250 others, or whatever the number is now as well. Every pound, my simplistic way of looking at it, every pound that we can generate from investments is a pound less that scheme employers need to contribute to the fund. But it will be something that we develop over time. I think Steve's right in terms of pooling is here to stay, but we do need to understand what our options are, shall we say.
Great, thank you very much. Christopher.
It's always very good to follow on from insightful comments from the excellent Councillor Mark Roberts. Maybe I'm in danger of becoming the Grim Reaper here, but it does occur to me that we've had a great economic shock with the invasion of Ukraine. Now, in the past, of course, we've had great economic shocks financially with disturbances in 2008, 2009 in the banking sector, and also in the past with respect to the Middle East, and perhaps that is a good comparative with 1973, 1974. So what stress testing have you envisaged on the basis of the investments that we have, on the basis that things will actually get worse? So if we look at where we are, yesterday we had a second month of negative growth. Maybe in the future we will have 2 quarters of negative growth and we will have a fully defined recession. But what stress testing could be done in these circumstances if there were to be some form of disturbance, etc., affecting global markets arising out of issues in the Middle East, i.e. to compound our already difficult economic circumstances, i.e. this is the question, what if things get worse?
Shall I try and get over it? There are 2 aspects to that question, essentially. There's the stress that occurs to the strategy, and there's a stress that occurs within the managers. So let's deal with the managers first. And I think the answer from Brunel will be something along the lines of we do some stress testing. We we look at risk models. We know the worst case scenarios, something along those lines. So there'll be there is modelling within Brunel. And then I'll let David respond to that in a second. But in terms of the strategy, you stress test that strategy by looking at the value that's at risk when you do a whole strategy review. So that's what you did about 2-3 years ago, and that's what should be happening when we do the strategy review which I think is scheduled for basically the next year. I'm not sure of the exact timing of that. So whoever does that strategy review will give estimates of kind of worst case scenarios. So those are the two aspects of that, I think. But if you were to ask that question today, not to my knowledge, I don't think we can give you a direct number answer to that today. It happens on and off at the strategy level, and I think it happens all the time at the Brunel level.
Yes, you're quite right. Yeah, so we look at stress testing across hundreds of different scenarios. So we run some quite complex risk models. We use a system called FactSet to do so. And as part of that, we stress scenarios, whether that's kind of recessionary and what kind of recession. It's kind of interest rates, it's market movements, it's reversals of different scenarios as well. So it's the positive and the negative. How do we do in each? And for each portfolio, the outcome we're looking for is different. So as I mentioned to you earlier, we've got our low volatility portfolio, which is currently doing exceptionally well. We would look there to, in these scenarios, does it keep a low volatility? Does it protect on the downside so it doesn't, does it not capture all the downside of markets? But we don't expect it to achieve all the upsides. When markets go up by 10%, we wouldn't expect it to go up by 10%, but when markets fall 10%, we wouldn't expect it to fall as far. So over the long run, it works when markets are up and down, as typically they would be. That would be very different for a high return equity strategy, where we would want risk to remain on the table. We'd want certain types of participation in markets, whether it's upside or downside. But what we always look for is the outliers, because we run it across, it's over 500 different scenarios we run our stress testing against. And essentially we're always looking for those outliers of what is not happening as we would expect it to. So that's if US markets fall by 30% and interest rates go up by 5%, and how does the portfolio behave? And if the outlier is something that we wouldn't want to see, i.e. it's a material movement from what we would want the benchmark to do, then that's when we look at it. So obviously we are relative to the benchmark on our portfolios. So that's how we always stress test it. Stress testing is only good to a certain extent because it's completely backward looking. It has to look at last time we had this happen, what happened to stocks like that are correlated or that are similar sectors or something. So I think we've been through, I think we had a catch-up call with Steve and David, etc. a while back, but this is a very unusual market conditions we've gone through. So my back testing, could I back tested a global pandemic? Well, I'd have to have gone back to the Spanish flu. Do I have enough data to do that? Probably not. But so you have to take other scenarios. Maybe how did China act in the SARS kind of scenario, for example? And SARS is one of the things we do run in our portfolio. And always have. But again, it's taking that historical data and trying to interpolate it into something. And I think we've been through a global pandemic for 2 years, which no one thought was going to happen, and then an invasion of a European country, which no one thought would happen. So it's that 1 in 20 event plus 1 in 100 event, one might argue, for a pandemic. So, but yeah, we stress test a lot, but not, to Steve's point, at your strategy level. So your mix of bonds versus equities versus private markets, that's obviously nothing we can do today. We can easily run it because we've got the systems, but we don't. So.
Okay, thank you very much for that. I think that's been a very thorough debate and analysis, and I hope you will, I'm sure you will take back the message that we are deeply concerned about underperformance and what's happened this year. And certainly, while I can understand the overall global effect of these shocks which weren't anticipated, it is always disappointing to see performance that is significantly worse than the benchmark involved. And I'm sure we will come back to that at future meetings as well. So thank you very much. Okay, then we'd like to move on to item 8. You're welcome to hang around if you want to, or to leave equally if you want to. Item 8, Councillor Beasley's report on Brunel's governance. Thank you.
Thank you. Thank you very much, Chairman. It's been a busy quarter since our last meeting, and I'd like to break my report to committee into 2 parts. The first is around Brunel and follows on very closely with what we've been hearing from Deputy Chief Financial Officer from Brunel. And the second part we'll move into the Scheme Advisory Board, because that has a very close correlation with some of the work that Brunel and the Oversight Board are doing at the moment, and in turn has implications for us here as a fund on our own. So to begin with, I've had a number of meetings in this last quarter with various people. I've had a couple with Laura Chappell, who is the Chief Executive Officer of Brunel, briefly with David Vickers, who is the Chief Investment Officer, and who I hope will be coming to present at our next quarterly Dorset Pension Committee. I think the members of the committee would welcome that. I pressed him hard actually for this one today, but unfortunately he'd already committed, I think, probably to another fund. But it is important, I think, that we get David here. Interesting as the presentation we've just experienced was, I think David is the person who we really do need to cross-examine over these performance issues in particular. In addition to that, I've had meetings which involved Aidan Dunn and David Wilkes with the shareholder officer, Alice Spikings, and we covered some issues which were causing concern. I think it was a useful meeting. And in addition to that, I've had an online meeting with Steve Tyson, and we did touch on some of these Brunel issues as far as performance is concerned. And some of them, I think, without Brunel being in the room, Steve will no doubt touch on with his report, particularly around asset allocation, around the valuation, and this issue of having a plan B in case plan A isn't all that we want it to be. And so what I'm hoping I can report back to committee today is that in terms of foreseeing these difficulties, I hope we're moving towards somewhere between plan A and plan B already, because I think it's really important that we do. And I think one of the key issues for members of this committee is that prior to pooling, of course, we had a much closer grip on performance from specific managers who we had appointed and to whom we would expect them to be held to account, and we would expect, if that didn't work, that we would take whatever action was required. My feel is around this that members of the committee, myself included, don't feel anywhere near as close to that as we did. We don't feel empowered to do as much as we used to do. And therefore, if there are performance issues, we instinctively don't feel that we're in control. And one of the issues that I've been trying to push forward with, as far as Brunel's concerned, is the issue of reporting. I find it quite unsatisfactory that there is just so much reporting, and we cannot cut into the important issues that we really want to address. I share the views that have been expressed around the Chief Executive's report, and what I've been keen to be pressing for, and outside of this meeting will continue to do so, perhaps with Dorset officers as well, is that we have a more streamlined reporting process. I'm quite happy to have all the data that lies behind it, but I think we need it to be more streamlined. We need it to be more frequent. Once a quarter isn't good enough. We need it to be regular so that members of the committee can be informed about the direction of travel, about any issues that are arising, and about any remedial action that might be taken. I think that will go quite a long way, actually, to getting the accountability piece and the performance piece to the very top of the agenda. Because very good as Brunel is in certain areas, and is probably one of the leading pools in the country, particularly around responsible investment, around ESG issues, around a whole range of topics which are right at the front of the LGPS at the moment. What we don't have is that issue about accountability and regular information reporting back to us. So I think that's something we absolutely have to do. And if we're then unhappy about what's happening within that reporting, my belief is that perhaps we could refresh that into something like a plan B. Because we've got to remember that Brunel has now, across the piece, had transition of about 80% of the collective assets within the pool. The Dorset figure isn't exactly that, but that's the average. And so we have gone a very long way already. So it'll be hard to pull back, but we do need to make sure that we feel that we're back in control and that managers are being properly held to account and the right decisions are being made. And absolutely essential in all of this is the issue of value for money. Are we getting proper value for money that we can then describe to the members of our scheme here in Dorset, and picking up points that have been made separately? Are we in a position of making certain that our funding level is going to be sustained not only out of this valuation that's taking place at the moment, but about future valuations as well? So the points made by Councillor Roberts a few moments ago are really front and centre of the thinking around that. And the other meeting that I shall be having probably in the next week is with Denise Legall, who is the chair of Brunel, because I want to make sure at the high level, the overarching level, she is aware out of all of these discussions of where Dorset sits. And I think Dorset is regarded as being pretty much a median within the composition of Brunel. So I hope that will produce something useful. Now, the second area I wanted to talk about briefly, Chairman, was the issues as far as the government and the department are concerned for pooling. And some of these come out of a discussion I've had with Laura Chappell, who is the Chief Investment Officer at Brunel, and the relevance that the Scheme Advisory Board on which I sit has, if you like, as the conduit between government and the pools. And that's a very interesting exercise, I have to say, at the moment, because Brunel is looking at a strategy review, and we had a workshop on that at our meeting last week. And within that review, there are many things to do with pooling that are being discussed by the government at the moment. And we are in a position right now of having the opportunity of influence if that's what we want. To do. So the pooling regulations consultation has been put back a little bit to the autumn, and that means that there won't be a lot of activity over that probably until about the end of the year. But I think it is very clear that the government are in listening mode. There are areas of pooling which aren't going anywhere near as well as Brunel, particularly in terms of transition and in terms of actually the ethos of pooling itself, and that's what the government are trying to address. But at the same time, the opportunity is there, I think, to try and make improvements if we can see that as being something we'd like to influence. And I suspect that we would. That's not necessarily for us to get to a conclusion on today, Chairman, but I do think it's something that members and officers might well want to think about so that they can feed that back into me and also, of course, by virtue of doing that, back into Brunel and then on to the Scheme Advisory Board and into government. The government have been very clear in saying that they are still listening. They don't always say that. But I think that they still have their eye on the huge value of the LGPS and what that can do for government, however unrealistic that aspiration may in fact be. But I think fundamental to all of us in this, of course, is what is the levelling up agenda going to mean as far as the LGPS is concerned. And we've heard varying reports on that, haven't we, around the percentage, about the reach across the UK, and about what actually infrastructure, which is what government have focused on as far as levelling up are concerned with the LGPS, what that really means. What is infrastructure? What are the definitions around it? And so I think that is something which I would really welcome some feedback on after the meeting today, so that over the next month or two, we can get into a much firmer position. And I think secondly, The other issue which I need feedback on is around the strategy review that Brunel is undertaking and went through the first iteration of at the Oversight Board meeting only last week. And what that entails is us having our say, hopefully enhancing what I've said we're already trying to get done over reporting and various other things, that we can then say to Brunel, in this review, we want to help shape the future of Brunel, and this is what we want to see happen. And we want to embed these principles into the strategy that Brunel is going to undertake. So those two areas, I think, I'd like feedback on. I don't want lengthy feedback. What I need really are bullet points and the rationale for those bullet points so that I can then take them forward to be able to represent Dorset properly. I hope that helps, Chairman. Happy to take any questions.
Yes, thank you very much. I think it's very helpful indeed. Thank you. Councillor Roberts, you indicated.
Thank you very much, John. I'm delighted that you are representing us with your knowledge and background. What are the other funds' concerns? We're mid-placed, I gather, in that. What are the bigger ones and what are the smaller ones? And I'm delighted I'm not a councillor in one of those pools that is performing much worse than Brunel and having to look at the finances of that council. But really, I'm keen to know, do other funds have the same concerns, or are they more content? Or really, are we alone in this?
Well, it's interesting, actually, because...
Sorry.
It's interesting, Chairman. The points that Councillor Roberts is raising are diverse as far as the constituents of Brunel are concerned. We spent a huge amount of time over the last couple of years on governance issues. Some might say we spent too much time because there were one or two, literally one or two, of the 10 members of Brunel who seemed to become almost obsessed by the governance issues, which actually weren't in very bad shape. They were just about evolution, which is what we'd always said from the very beginning. What we do at the beginning will need to be reviewed, will need to be refined, and will evolve over time. And that's been the case. But of course, what that meant was that in doing so much work over governance and, if you like, making sure that the direction of travel was very much around the responsible investment agenda and everything that's associated with that, it's been my feel for quite some time that performance, whilst it may be very closely monitored and considered by Brunel centrally, it wasn't necessarily something we were seeing, A, the evidence of, and B, getting proper reporting back to us. And I think we've moved on from there. I think it's an acceptance that those other issues are now in the past, and we can now get on to actually what is the most important issue, certainly for everybody on the Dorset Committee, which is around performance. And we're only interested, I would suggest at this stage, in that one area of activity. And provided that is coming through, then I'm sure that we will make sure that the rest of our transitioning takes place.
Thank you. Steve, yeah.
A bit of a response to that as well, because I'm curious about exactly the same thing. So via MJ Hudson, who I work for, there are other independent advisors who are independent advisors to Devon, Gloucestershire, Oxford, Wiltshire. This is just within. So, I mean, I talk to those guys, the equivalent of me at those other funds. And you know, the main topic of conversation is that people it's like here, everybody's concerned about the performance. That's the main thing, because at the end of the day, that this group of people like me are looking at investment performance, and they're looking at the impact that might ultimately have on the funding ratio and then on contributions. So we're concerned about the issues that you raised earlier. So that's what we're focusing on. How Brunel compares to other pools, as far as I'm aware, there isn't really much data on that. It's still relatively early days, but I think there needs to be data on that. I mean, we need to have that information. So, I mean, I will try and make some connections with some other independent independent advisors at non-Brunel pools, because that would be interesting information. The bottom line is that we're missing some data, I think. But it would be useful for maybe Dorset to try and source information on how it stands in relation to the other 89 funds in the country. I mean, that's information that I don't see is available at Dorset, and that would be, I have seen that in other places, like Devon and Gloucester, we saw that. So it seems to be not something we have here, but something we could perhaps look into getting.
Thank you. What I'd like to suggest, actually, if that's all right, probably to drop David in it a bit. Once you're feeling a bit better in the next couple of days, if David and yourself please can have a word with each other, draw up some sort of questionnaire or some ideas, and put out maybe an email to members. So I'm conscious that there are quite a few members of the committee who aren't here today. And we want everybody to have a bit of a feedback on that. So I think if the two of you could have a discussion about how the best way forward to do that is, and to get people involved, I think that'd be very helpful. Okay. Is there anything else? Otherwise, I'd like to move on. Sorry, Councillor Christopher.
I would be interested to know how many hits we actually get on social media or otherwise in connection with our pension committee. It would be fascinating to know how many people actually watch our deliberations after the event. People who were to actually do so will have noted those insightful comments of Councillor Roberts and Councillor Beasley. The average council taxpayer in Dorset, I suspect, doesn't have an appreciation about the huge liability that Dorset Council has under a defined benefit scheme to its current and past employees. And clearly that liability would just dwarf the council tax base. And we've heard commentary about the fact that we should be meeting more than once a quarter, and the fact that we should be having perhaps information presented to us in what you might perceive to be in a better form. And I do wonder, Chairman, whether you could actually convey some of those concerns to our Dorset Council leader and the Cabinet as we move forward, so that we actually change what we do and we change the regularity of our meetings. And we perhaps stress to all Dorset Council members the size of the liability in respect of a defined pension scheme, so that the work of this pension committee perhaps is better publicised.
Yes, I'm sure that makes a lot of sense, actually. I think particularly as we're going into this period of reviewing our whole strategy and the way forward, and part of which will be discussions about contribution levels and all that sort of thing, it does make more sense to publicise what work we're doing throughout the council and make sure that members are fully informed, or if they feel like they don't get enough communications from us, that they perhaps know where to go to actually find out the information themselves. So as you would add to that.
And a follow-up, when you actually have that discussion, you may want to note the concern about the amount of the Dorset pension fund that is actually invested via Brunel, and that might not necessarily be the strategy that the average Dorset Council member would actually like to see with respect to their own pension pot. Thank you.
Sure, I take the point. But effectively, we're being driven, as we are with so many things, by central government policy on this. If we want to challenge the whole concept of pooling and whether it's working properly or appropriately, I think that has to be a bit more, like we said earlier, we have to have a bit more data on that. We need to be able to show what impact it's actually made. I mean, it's still relatively new. And we need to be able to show over the long term that it has actually added value, or not. If the numbers don't back that up, then I'm sure at some point in the future we'll be going to the government and saying, well, look, the government structure doesn't work. Maybe we should be looking at something else. But I think as things stand at the moment, we don't have the data either way to prove whether the moving to Brunel has been a good idea or not. but it is something we will have to do in the future. Okay, I'd like to move on, as I'm conscious of the time, on to Karen's report, item 9, for pensions administrations. Karen.
Good morning. The report this quarter isn't too substantial, so I should be able to go through quite quickly. You'll be able to see the one appendix there for the key performance indicators, and you'll see that there is some improvement there, which is largely due to the change in the modifications made to the reporting system, as that's been fine-tuned, as I've explained to you previously. It's been a work in progress. We are still struggling primarily with the main critical areas of technical side of the work because of the losses of staff, which unfortunately is continuing. So where there is the most difficulties and the most pressure on the team is unfortunately in that sort of key area. The team are working extremely hard, and we're doing everything that we can to look at the main priorities that we have and to move ahead so that we can recruit going forward. But overall, things are as good as they can be, and the team are continuing to do a very good job in difficult circumstances. I've put in a systems implementation update, but I won't continue to put those in going forward. We will be moving to the point where the system has been in for a year next month. And the major issues that we've experienced are now sorted. There still does remain some issues, some data that has to be cleansed, and some improvements to the system, all of which are sort of ongoing jobs. But we are in a position where all the significant areas and the areas that would have been of a concern to you, we are confident about. So we're confident about the quality of our data. We're confident that the reporting of that data, so for example, the reports that we need for the valuation are working well, and that we will be able to issue our annual benefit statements. And in fact, the deferred benefit statements are due to be issued very soon. So the sort of significant statutory requirements and concerns we would have had, we're feeling confident about. So I'll only update you if there is something of concern that I feel you need to know about. Item 13 is a pensions dashboard programme. What I intend to do with the dashboard programme and with McLeod is to keep that in as a regular update, even if there is no significant progress or movement that quarter, but because these two items are so significant to the industry and will have a huge impact on us and all pension providers moving forward. So obviously with the concerns that we have about the shortfall in experienced staff, moving into things like this is a concern. The dashboard programme is significant. That's a government initiative, and we will be moving towards going live in that 2023 or 2024. But the infrastructure we are looking at now and an ISP provider. So these are significant developments because there needs to be a sort of third party between the dashboard and the data held by the pension fund. So there's a lot of security discussions going on, and it will be significant. So I'll keep you updated with that as we go along. We're currently looking at options over ISP providers. We don't have to stick with Civica. There will be possibly advantages to that, but because of the high costs involved, we are just exploring other options as well currently at the moment. The staffing update I have mentioned, that continues to have an impact on us, and I'll continue to update as that goes forward. Item 15 is perhaps the most important area to update you with for this administration update, because this is such a huge thing for us, the end of year update. So this is where we basically get data from all of our employers. We've got about 160 employers. This feeds in, so this calculates every member's pension that's been earned in that year. It also, of course, feeds into important things like the valuation data, provides the annual benefit statements. We're looking at pensions tax and annual allowance, And we do really important checks on the data that's provided to us by employers. Have they provided us with all information about leavers and joiners, additional contracts, etc.? So this tends to highlight a lot of issues that could potentially exist with employers and our data. So it's really, really important. And this year it's especially important because of the valuation. We've had to get everything done and dusted in quick time. The new system has dealt really well with the end-of-year processes coming in, so we're really pleased with that. Unfortunately, our employers who there's a huge range of employers in the LGPS. Some are resourced better than others. Some engage more than others with us and with our processes. Our biggest challenge this year has not been the system, but has been employers. We usually have a few employers that struggle to provide this data and have defaulted, but we've had more than normal. We've had significant issues with quite a few employers. So those employers, they may be big employers or they may be small employers. Their issues range from lack of understanding, changes in their staff and their system, that sort of thing. A big significant area of issue has always been with schools and academies outsourcing their payroll, and we've had a number of issues there. So the things that we can do about that is obviously we have been really intensely engaging with those employers where their data has been inadequate. We will be issuing financial penalties under Regulation 70, which we can do to recoup the cost of additional work where employers haven't been fulfilling their function properly, and that's caused us issues. We have also spoken to the actuaries about what we can do about employers if their data isn't acceptable for the valuation, and the need to make assumptions. That's quite difficult with academies because they're pooled. But essentially, I think we will avoid that, and we have done everything we can to avoid that so that the valuation can go ahead for all employers and, of course, the academies and anybody that are pooled. And where there continues to be a default, we will omit individual members from our system going forward, and we will write to those members to tell them that no pension has been credited to them this year because we have not had the data as required from their employer. And that, we hope, will prompt employers to take a bit more notice and get the information to us that we need, because obviously we need to do the valuation and we need to issue everyone with an annual benefit statement. Those are statutory requirements, and we need to obviously assess everybody in the fund for the annual allowance tax. Does anybody have any questions on that before I just finish up?
Just indicated a little earlier. Actually, on the first part of the report, I'll probably come back to the bit you've just covered there because that's quite interesting. Just the first part of the report on the key performance indicators. Unfortunately, my link in the report wouldn't. I don't know how to access the appendix that gives the KPIs. I don't know if it's the same for all members, but the link in the report didn't seem to work. So I'm not sure where that would be.
It's separately on ModGov under the supplement.
Yeah, but the link that goes to the appendix that gives us all the KPIs doesn't give, the links to the background papers work, but the links to the KPIs doesn't work. So I don't know whether members have been able to access the KPI table or not. It's the first link in the report that we've got before us, but that's, yeah, so that was just one slight aside, I don't know.
Thank you. I'd like to ask questions on two particular areas. Before I do, to put into a context the lifetime allowance for individuals, if we go back to 21-22, the limit was 1.8 million, and for the current tax year, it's 1,073,100. So my first question is about the number of individuals who are affected and the amount of time that has to be devoted to the whole question of whether people are breaching the lifetime allowance, or indeed the question of the annual allowance, and looking at the 3 previous years, etc., and the complexities of that. And my second question revolves around the outsourcing of payroll and the amount of time that has to be devoted to resolving issues. Can you, in some way, clarify the level of those particular problems, even if you cannot do so in the meeting today, but perhaps by emailing us after the meeting? Is that possible, please? And thank you very much.
Yes, I can certainly provide you with any information that you want. The lifetime allowance is a pensions tax that's assessed when people are leaving. In the LGPS and the Dorset Fund, there's not a significant number at all. But when there is a member impacted, then the calculation of the lifetime allowance can be very complex for the fund and for the member. So the amount of time spent on that is not huge because the numbers impacted are small. The annual allowance, which is an annual check of pensions growth and potentially a tax charge, that is much more challenging for the fund, and we spend a lot of time on that, making sure that the data is correct from the employer, and making sure the calculations, which are extremely complex in the LGPS, are correct. So we usually check about 150 records each year in detail, but the number of people actually impacted with the tax charge is usually between 15 and 25. So not a huge number, but there's a huge amount of risk involved with the annual allowance. In regard to the outsourcing of payroll, this isn't a new problem to us with schools, and we try really hard to engage with schools, which are quite a little bit more of a distant employer, some of our others. We've held seminars for schools before, specifically to help them with their issues with the LGPS. They do struggle with their responsibilities with the LGPS, not just in regards to the provision of data, but also in HR and related issues to do with the LGPS. And we have, and we always do, advise them to make sure that when they outsource their payroll, that full consideration is given to the requirements of the pension schemes that they operate. Unfortunately, sometimes they just go for the cheapest option, and then has happened now, several schools will be invoiced in the next coming months for defaults of provision of data, and they will be, I think, from what I understand, they're going to be passing this on to their payroll providers, but it causes a huge amount of work and additional cost. So we try really hard to engage, but sometimes those messages don't quite get through, or they simply go with the cheapest option. But we do continue to provide a specification for new payrolls and remind these employers of their responsibilities. It's a bit of an ongoing challenge. Is that? Thank you.
Thank you. Yes, Karen. This arose as an outside body that I happen to chair on maximum employer contributions, and it appeared that they were following guidelines from Dorset and Hampshire of 14%, and someone else involved said, well, Suffolk is 22%, and I wondered, A, is it up to each employer within the pension scheme to set an upper limit of employer contributions, or is it standardised? And how does that work across other local authorities? Thank you.
The employer contribution rates for any employer in the LGPS is set by their actuaries on an individual basis. So they will vary within funds and from funds to funds. And they can vary quite a lot. And they're a primary and secondary rate. And what I'm wondering there is whether one of those figures is just the primary rate, which is usually maybe around 15–16%. But sometimes if there's a deficit, there can be a higher secondary rate, meaning that you can go up to 20, 21 or 23. So it's a bit of a mixed picture, and we'd probably want to understand a bit more about that.
Thank you. That's partly. I think the implication I was getting was that the more senior the employee, the employer contribution also increased. Is that still the case in Dorset? Yes, the higher the level of salary is sometimes followed by a higher employer percentage.
I see what you're saying. So you're talking about, there's two different things here. There's the employer contribution rate, which looks at individual employers and their individual members and liabilities. There's also the members' own contribution. So what happens there is there's set contribution rates that are index linked each year, and they're tiered. So for higher earners, the more you earn, the higher your contribution will be. It could go up to 12.5%. So bearing in mind that the employer contribution rate is a percentage of their payroll and their pensionable pay, yes, they will be paying more, you could argue, although you'd say the contribution rate is a flat rate of everybody's pensionable pay, but the employees have a tiered contribution rate that's set nationally and won't vary between funds.
I understand about the employees. It was more whether high-paid employees also attracted a higher employer contribution as a bigger benefit.
It's a flat contribution rate for the employer based on the payroll. Yeah. Yeah.
Thank you, Councillor Roberts. That almost sounded like you were getting a bit of free tax advice there. But there was any further questions for Karen? In which case we'll note your report. Thank you very much, as always. Then moving on to the Independent Advisors report. Steve, over to you.
About 15 minutes later, we're getting on to Federated in 6 minutes' time, so I'm not going to run through my report, basically. A lot of the things I was going to say were, I'm happy to take questions, a lot of the things I was going to say were effectively covered when David Cox was talking about the economy. We know what the issues are: inflation, interest rates, central bank tightening. It's a very difficult environment for all pension funds at the moment. We're no exception. And, you know, my basic feeling is that we're heading towards recession in the UK and the US, basically. I think we've got a recession coming. This is what happens in an economic cycle. It's going to be pretty grim. And the key to me is, as to the depth of that, is probably how transitory is inflation, because obviously you'll get the anniversary effects where, you know, the oil price was higher a year ago, and so the next year headline inflation will start to head down. So how transitory is that? Is it a plateau, or is it a kind of up and down? Because that will then determine the level of interest rates. But I think it's going to be pretty grim. I think the central banks need to I said it last meeting, I think they're way behind the curve and need to start increasing rates pretty quickly. And I think the Fed will put up rates by at least 75 basis points tomorrow. And then the Bank of England won't be far behind that. So, yeah, I think would you like me to run through my report? I mean,
I think we should actually take it as read that when you written reports that members have read them. Therefore, I think each question is whether you want to add anything to the report rather than actually to just repeat what's already in there.
Nothing really. No, I don't. No, I'm happy to take questions.
Thank you very much, Chairman. I think my question is very much around asset allocation. And given the likelihood of the changing economic circumstances, already some of those have occurred. I completely agree with Steve's suggestion around a forthcoming recession, and I just don't feel that necessarily we have reviewed our asset allocation in those circumstances since the last time that happened some years ago, and I think we ought to do it as a matter of priority.
Yes, it is certainly a priority for us going forward. I think what's particularly difficult is the funding position, at least as much as we were aware of it. Obviously, we haven't yet had final figures, but the funding position of the fund is challenging and virtually forces us to take a relatively high-risk approach of having a large percentage in equities to look for long-term growth. Whereas at the same time, in the short to medium term, we might be looking at recession and difficult times, which would naturally probably reduce our exposure to equities and look to invest in other products. So I think there'll be a tension between those two thoughts as we discuss matters over the next few weeks and months. Obviously, we are literally beginning to start this strategic review, and it will be based initially on our actuaries' point of view about what the current level of funding is and what we might need to do to correct it or otherwise. So until we've actually got that data, we can't start the review, but once we do have that data, we will be fully into the strategic review, and we anticipate a lot of time spent discussing all these issues in September in particular. Steve, you want to add anything?
Yeah, I thought this question might come up, actually, so I had some in my notes. I had something on exactly this point. I don't think pension funds are typically nimble enough or confident enough in their predictions to sell and buy back. I think that's unwise. I don't think we've got the governance structure for it, basically. But it's definitely time over the next few quarters, and including the strategic review, to be working on the strategy, to be working on the governance, and in order that we're in better shape for the longer term. That's the way I think about it.
Sorry, bet you couldn't hear that, could you? Sorry. I was saying, David, do you want to lead us on item 11, or is Charlotte taking the lead on that?
No, I'll do it, Chair.
Okay.
Chairman.
Over to you then.
So, in the interest of time, I will take the report as read. So, a couple of things just to highlight, I guess, is that we talked about the performance for the quarter. So, minus 2.6 against a combined benchmark of minus 0.3. Over the 12 months, there's still a good level of performance, 10.1 in absolute terms, but that's still below the benchmark. The main driver for the detractor to performance has been those Brunel active portfolios, and members have had a good opportunity this morning, devoted a lot of the time of the agenda to questioning the Brunel officers on that. One other thing just to point out is that typically in these reports there is an estimated update on the funding position provided by the actuary. More eagle-eyed of you will have spotted that the figures in there are as at 31st of December of 88%, I think, as opposed to 31st of March. And that's because when the actuary is undertaking their full review, they don't do the indicative figures. So as I mentioned earlier, we're expecting to see the indicative results of the actuary's work in time for our September meeting, hopefully. And just another point just to raise there, Councillor Beasley mentioned that Brunel as a whole had seen funds assets of 80% of the total client funds going across. Our percentage is a fair bit lower than that average at about 61%. And the main drivers for that are our direct property investments that we hold outside of the pool, and also our liability-driven investment mandate with Insight, or our inflation hedging mandate with Insight. So those are the two big ones. But we've also got some corporate bonds as well, which is outside of that. That's all in the interest of time, that's all I wanted to say at this point. Thank you.
Thank you, David. Are there any questions, David? Councillor Roberts.
Only a comment which I think goes back to our earlier questioning of Brunel. If we look at the table in this report and look at the red, it is rather scary on the Brunel side and much more pleasing on the 39% of the fund that we still manage. It was really just an observation.
Thank you, Councillor Roberts. I think it's an observation that we've all spotted, and I'm sure they're aware of it too. Did you want to add anything to that, Steve?
Small qualifying point to that. I agree. Just be aware that the private markets I'm not referring here to federated homes, but the private markets, some of those, there's a lag in the valuation. So you're not seeing bear market pricing yet in private markets. If you look at, actually, this may seem like an oxymoron, but if you look at listed private markets, I saw this the other day on a table somewhere, I can't find it. Listed private markets trusts are down something like 20% this year. But of course, that's just because of the catch up. There's a delay. So and some of those numbers, I think are just, not, they just haven't caught up with reality yet. So that's the only qualification to that statement, which I basically agree with the thrust of it.
Right, in which case we'll move on then to item 12 and dates of future meetings. I'm sure members are all aware of the discussions that took place last time about locations of future meetings. But basically, we are a bit stuck in the sense that these meetings, the formal committee meetings, have to be open to the public. We have no choice in that matter. And there's a feeling that our partners and organisations where we do meet in London would not want to have a policy where literally anybody could turn up at their doorsteps and ask to come into the pension fund meeting, which they would legally be entitled to do. So the recommendation is that we carry on having our formal meetings in London, but that we have a 2-day training event on Wednesday the 14th and Thursday the 15th of September in London, when we can get into all of the big issues that are coming up in the future in a free-flowing private discussion, which is not on the record, and to cover things like inflation hedging, property, and our environmental policies and disinvestment from oil and gas and all those other things. And basically it enables us to look at all these issues with the experts at our beck and call, and we question them and debate with them. And then from that we develop policies that then come forward to the public meeting. At least that's the current proposal anyway. Councillor Roberts.
My memory of the last meeting is that we had agreed to do, that certainly the last time we met in London, the formal meeting was in a hotel. It wasn't at any of the managers, and of course it could be open. And the hotel at Waterloo, which I believe we have an investment in, seemed to be an ideal place to hold that, as it's open and not an investment company. I'm struggling that we can't return to that for 2 of the meetings a year, which we seem to have managed successfully for many, many years without anybody raising an issue. I'm struggling with that.
David, do you want to go back on that one?
It's something that maybe we can take away, that option. I think the last meeting that we did have was in Insight's offices, and I think also it is something that for many years is not, to be blunt, hasn't been an issue, because there's been very little interest in the members of the public, if you like, in the activities of the pension fund committee. So whilst the meetings have always been available for members of the public to attend and not to leave their name, they don't need to leave their names, they just need to be able to access the meetings. In some respects it was an academic point for many years. It's only perhaps in the year before we went into the COVID kind of restrictions that we started seeing a lot more interest in the activities of the pension fund committee. So it's, well, for that reason it's become more of an issue. What I don't know is, clearly having the meetings in London, even if they are open to the formal meetings we are talking about, so we just need to make that distinction. We're absolutely not in any way saying that if members of this committee feel that the best way to discharge their duties is having training sessions in Dorchester face-to-face, online, or in London, or probably a mix of those things, that we can do that. And that's why we're suggesting that we have a dedicated training event over 2 days. I think this meeting has demonstrated there's a hell of a lot going on and a lot on the horizons. I think that we perhaps do need that extra kind of that would create an extra opportunity for some more time to get under the bonnet of some of the issues that we've skimmed over a little bit today. So we can, if members want to look at that option as the hotel, it would mean, you know, I can check it with the hotel, but I suspect they would still have a concern about people just coming in off the street and just wandering into a meeting room.
Thank you, David. I think the bigger issue with the hotel might well be the technology, in terms of being able to, we also have to stream this meeting. Whereas we would expect our fund managers to have the technology to be able to do that side of things. They would be less keen on people coming into the meetings. But yeah, I mean, Adrian, so you got your hand up if you wanted to add something.
Yes, thank you, Chair. I'm conscious that part of the changes which are being proposed for us all as local government, or local pension scheme members, is the amount of training that we're going to have to do. So I think we need to build that into our processes going forward. There was an intimation that possibly 4 meetings a year weren't going to be sufficient given the complexity of what's going on for the pension scheme. So I'd be glad that those would be considered.
Again, I'm minded to agree with Councillor Roberts, and to put things into a perspective, Chair, I suspect, and it's quite fitting we're talking about a Russian, when you and I were studying economics years ago, we were looking at Kondratiev trade cycles. I don't imagine that we were actually looking at technology life cycles, and clearly the world is much more complex, and therefore we need the appropriate training, and I cannot believe that it's impossible, that it proves impossible to have a meeting in another place where advisors are more readily available to actually provide training within a locked room.
Well, ultimately, you as members are responsible for this. If anyone wants to make an amendment or propose an amendment or change something, that you can do so. Or the officers can just take away what our concerns are and look to change things, to go back with different proposals next time.
It needs to be held at a subsequent meeting where there is greater attendance of members of this committee.
Well, I'm happy for it to be on the agenda next time round, when we should be dealing with a lot more issues. So hopefully there will be a lot more attendance. Okay, so that's proposed. Councillor Roberts, are you happy to second that?
Yes, could you clarify what November was? Sorry, I'm on the wrong part of the agenda, probably. Was it September or November? I'm not sure. You mentioned
the training event. September. 14th and 15th of September. It's not on the published document that you have there. That just has the committee meetings. It doesn't have the proposed additional training 2-day event.
Chairman, could I just clarify from David Wilkes, because I've got the 21st of September in as the committee meeting. Are we now talking about the previous week and combining it with the training?
If I can clarify, we're suggesting that we're proposing that the meetings take the formal committee meetings that under statute have to be open to members of the public to attend if they wish. That is held on Wednesday, the 21st of September in County Hall. However, what we're proposing in addition to that is that the week preceding that, on Wednesday the 14th and Thursday the 15th, that we put together a training event in London, so travelling up to London on Wednesday the 14th, morning of Wednesday the 14th, staying overnight in London, that night and coming back on Thursday, the 15th of September. But that is solid training. The formal meeting will not take place in London on those dates.
So that's the proposal, and equally, Councillor Christopher has made a proposal, seconded by Councillor Roberts, to review this at our next meeting. Any all those in favour? That is the next meeting. Yes, it is the next meeting, yes. Yes, it would be, yes. Yes, yes. So I'm talking about what we do going forward, as opposed to what we do in the immediate future. So can I see all those in favour of discussing it next time properly, in depth? Yeah. I think that's everybody in the room, actually. I think members have made it pretty clear what they want now on several occasions, and I really do think that David and all the other senior officers need to go away and think about how you're actually going to deliver this, because there's clearly a member upset at the current situation. I think we've made that quite clear. Right, moving then on to item 13, and we're going to be moving into exempt business. So could you at this point stop, please, the recordings of the meeting?